Jai, thank you so much. I won't go into any long introductions. We all know each other. This roundtable is a discussion forum where we're expecting our panelists to speak for about 10 minutes or so. And I'll come to the other panelists. But Jai, why don't you start? And at least we'll make sure that we have your full 10-12 minutes before you have to leave. Jai?
Shekhar, thank you very much. It's a pleasure to be back speaking at the India Policy Forum. It's a wonderful roundtable that you put up. I'm afraid I do have to be rather cryptic, and it isn't just in a guest, it's actually a meeting. And so let me start by straight away coming to the issue of, the topic is, what does the pandemic and India's economic shutdowns teach us about meeting our economic growth and jobs challenges? So first of all, I must emphasize that this is, of course, unprecedented. Nobody in living memory has had to deal with such a challenge. And every leader in the world had to take a part of the decision without precedent, without having all information on hand. But it was clear from the experience of Europe and other countries that India had to take drastic steps. Because if you turn the clock back in February and March, many epidemiologists had predicted dire consequences for India, running into hundreds of millions of corona positive cases and a very, very large number of deaths, which fortunately has not happened. We did see that leadership on display in the Prime Minister's many exhortations to the public, because unlike some authoritarian countries, India can't work to a shutdown just because the government announces it. It does require buy-in by people, and we saw that happen. So the first major policy choice, of course, was that lives were prioritized over jobs, and the Prime Minister explicitly said so. And to a very large degree, India has been very successful in saving millions of lives, if you look at what had been predicted and what is the outcome today. But two or three things about jobs. From day one, when the lockdown happened in India on March 25th, the government of India announced the first tranche of the economic stimulus package, which would later on add up to 20 lakh crores. That first tranche of 1.75 lakh crore rupees was aimed squarely at the bottom of the pyramid. And that was because, unlike what many people allege, the lockdown wasn't done in a hurry. There had been a cabinet level group monitoring the corona situation from mid-January, and the decision taken was in consultation with chief ministers. So it was known that it would cause a lot of disruption. So, in that first tranche, you saw 22 million migrant workers get cash transfers into their Jan Dhan accounts within the first 3 or 4 days. Now that's fairly spectacular. And you saw a similar thing for about 80 million rural women. Now, this was possible because of the JAM trilogy. This was possible because of technology. It wouldn't have been possible 5 or 6 years ago. Recall how much opposition there was to the scaling up of Aadhaar. And recall how when the Jan Dhan accounts were being scaled up, many treated them lightly because they had only 1 rupee in the account. But this is where large amounts of money were transferred to save the bottom of the pyramid from the jobs crisis that happened immediately with the lockdown. Now, I've had some intimate experience with this over the past 4 months because of coordination activities that I was doing at a party level. I come from a state, Odisha, which, like Bihar and Jharkhand and a couple of others, have a very large population of outstation migrant workers, out migrants. But we saw, for example, just to give you an idea, in Odisha, we were expecting something of the order of 2 million or 2.5 million migrant workers to come back when the trains were finally facilitated after several weeks. But that didn't quite happen. We only got about 600,000 or 700,000. It goes to show that the planning and the cash transfers and other measures, such as, for example, the decision taken for grains, food grains, to be made available to up to 800 million people, whether they had a ration card or didn't have, initially for 3 months and now extended till November. is what staved off the consequences of the jobs crisis that happened due to the lockdown. Now, I would like to say that the shift of gears into dealing with the economic consequences of the pandemic happened after the first few weeks, apart from the initial tranche of 1.75 lakh crores, which I just mentioned. And you're all familiar with that, so I don't want to go into it. But it's not as if the government was lackadaisical about it. The priorities were right to save lives first. The first focus was the lockdown, the hospital beds, the ventilators, the PPE kits, and so on and so forth. But within about 5 or 6 weeks, the shift of gears to the economic revival package was very evident. So I would like to take stock and say that, of course, the economy has been hit, but it's the case for every country in the world. There's no country in the world that has escaped negative consequences on the economy because of the corona pandemic. But as we look at the situation today, we are getting several reports of green shoots again showing up in the Indian economy. The RBI governor himself has said so. Several well-known economists, both domestic and global, have pointed to this. If you look at petrol and diesel consumption, they're back up to only about 18% less than the level of April, whereas they had gone down to 60% of the April level. If you look at power consumption, it has climbed back up to 90% of last year's demand. If you look at GST collections, again, you're seeing the recent figures are about 90% of financial year 20 average. These are June figures. So the bounce back is quite evident. And even if you look at unemployment, which is the topic of this session, you've seen that unemployment figures are coming down in June compared to the earlier month. So I will wind up at this point and say that we still have a long haul ahead, because this has been an extremely disruptive 4 months. But we've seen other countries, we've seen that, for example, in the US, the jobs numbers have jumped back. And I think there are predictions in India that we will have that kind of a V-shaped curve looking forward. And I'm sort of cautiously hopeful that that happens sooner rather than taking longer. Thank you very much.
Thank you, Jai. If we can claim the remaining 4 minutes before you have to leave, may I just pose a question and ask for your thinking and that of others in government on how we deal, if we deal in any specific way, with the issue of migrants, both those who have left, those who are coming back, and does this expand the set of challenges that we have? And any thoughts on this, please?
So the first thing to keep in mind is that what you saw if you were watching the media with the migrant crisis, the reality was somewhat different, because 99% of the migrants, they faced hardships, but they didn't face the kind of crushing hardships that you saw in a few thousands that had to walk on the roads, and media covered that extensively. I know, because being from a state that has out migrants, I was coordinating 12 hours a day, and I can tell you that something like 99% of migrants, wherever they were, in Mumbai or Surat or elsewhere, were getting relief, and not just the government funds and food, but also NGOs, my party, for instance, and others. But when the exodus happened after a few weeks, when the trains were made available, as I was saying earlier, not as many went back as we thought. And those that did go back, you've seen this renewed effort of the Manrega plans, so that they are kept fruitfully occupied in their states, in their villages, for the next few months until they're, they will have to go back, because places like Orissa, Bihar, and Jharkhand cannot provide these number of jobs in the short term. In the medium to long term, yes. And you have a counter problem. When I've had lots of similar video interactions with industry association, MSME owners, and their concern after the initial month was that, look, the migrants were holed up here, but our factories were shut. and now the migrants have gone home and we are ready to open the factories. So there is a little bit of a lag, but I'm beginning to see the reverse migration already begin to happen. So I think we can see over the next quarter a lot of that happening.
Thank you very much, Jay, and really thank you for sparing the time. I know that you have guests and you have a meeting as well. So just stay till however long you can, and we will then move to the next person on our panel, and that's Jahangir Aziz, who is the Chief Economist for Emerging Markets for JP Morgan Chase in New York. Jahangir, about 10 to 12 minutes.
Sure. Thanks very much, Shekhar, for the invitation and for getting such a high level of panelists together. I'm going to. Shekhar asked me to talk about emerging markets, and I'm going to talk 5 minutes each on the growth outlook and 5 minutes on the policy. I think the two of them are intertwined, and two of them are critical, and especially given what was just said by Jai Panda about the fiscal response. I will put India's fiscal response in the context of the size of the shock that India is about to face or is facing, and what is happening elsewhere in the world. So let me just start with the 20,000 feet view of the world. In 2020, we meaning JP Morgan, we are looking at a -4% decline in global growth. That will be split between the developed markets, which will go down by about 5.5%, and emerging market will go down about 2%. But that 2% going down is actually, needs to be, it obscures the fact that much of that is because of China actually posting positive growth. China, in fact, is the only country in the world where we think there will be positive growth in 2020. I will get back to China in details later, which leaves us with ex-China emerging markets, and ex-China emerging markets will go down as much as that in the developed market. It goes down by 5%. But that's not that, but this kind of an growth reaction should be obvious. What is not obvious is what happens in 2021. So in 2021, there is a recovery, and we talk about a V-shaped recovery. Yeah, if you're going to look at growth numbers, growth rate numbers, the growth rates of almost every variable is going to plunge and it's going to go up. And if you have a chart with just growth rates, it's going to look spectacular. But that's not the problem. The problem is what happens to GDP level, i.e. what happens to the amount of GDP or amount of actual activity that is lost. And so when we look at the recovery in 2021, the recovery is again, a very, very sharp recovery taking place globally, in a developed market, in emerging market ex-China. But then you start looking at the levels. And the level of GDP at the end of 2021 will be about 4.5% lower than 2020, than 2019. It will be 4.5% lower for developed markets. It'll be 4% lower for emerging markets. And remember, in emerging markets, we're including China. If I exclude China from emerging markets, it will be 6.5% lower. So what does it essentially mean? That by the end of 2021, the world would have approximately lost, using current exchange rate, about $3.3 trillion worth of GDP, which is about the size of the Indian economy or slightly larger size of the Indian economy. That's the overall shock that the world is going to face. And within all of this, if I look at where India stands, we have India growing at a -6.5% in 2020. That's probably a little higher than consensus. It does recover. It recovers by about 8% growth rate in 2021. But then again, in level terms, we're losing about 9.5 to 10 percentage points of GDP in level terms. So this is a very serious loss to India. And I'll go back to India back again when we talk about policy response, that the policy response needs to be commensurate to that. Let me shift now from the overall 20,000 view to what is happening on a high frequency basis. When we want to look at high frequency basis, let's divide up the world into China and the rest of the world. In China, the recovery has been, by any account, spectacular. It's been a sight to behold. By May, China managed in level terms to get back to its industrial production back to its January levels. In June, it is ahead of its January levels. On the demand side, consumption has been lagging, but if you look at consumption, growth has been very strong, including in durables. If you look at other parts of demand, infrastructure spending, real estate spending, again, the growth levels are very strong, even though the levels are somewhat lower than what it is lower than production. At this pattern of development, where we expect production in China to be kept at its pre-crisis level, whereas demand is going to fall short of the pre-crisis level, both in terms of exports as well as terms of domestic demand, will mean that in the case of China, much of the growth in 2020 will be driven by a massive inventory accumulation. And now this is important because growth of an economy of the size of China, if that's driven by inventory accumulation, it will put significant amount of disinflationary pressures on manufacturing prices, not just in China, but globally. In fact, in the case of China, while we have growth, going back to 2.5% of GDP in 2020, which given the shock in the first quarter is spectacular, we have, in somewhat, contrary to that growth dynamics, we have headline inflation actually turned disinflating and becoming a deflation in the fourth quarter of 2020 and continuing into the first half of 2021. And this pattern is important because what we do expect, therefore, is that monetary policy easing to continue in China, both in the credit side and interest rates to come down. And this is going to be an important anchor for the rest of emerging markets, because there is one piece of emerging markets, external conditions, which is the China demand, that will actually continue to keep ex-China emerging markets, supported. So that's sort of the China story. If I look at developed market, the developed market story is somewhat different. We are going to see, as we have already noticed over the last couple of weeks and month, that consumption demand is coming back and coming back very strongly, both in the US as well as in Euro area. And unlike China, the recovery in the US and in the developed markets, and in Euro area, and particularly in the Euro area, is going to be driven more by a resurgence in consumption rather than a resurgence in production. And so we have a cycle in the second half of the year where we are probably going to see Chinese production surging ahead, Chinese consumption lagging, whereas in the rest of the world, it will be consumption that will be driving recovery, and most likely it will be production that will be lagging. And that's sort of the cyclical mixture in terms of high frequency. Let me just stop here on terms of the global growth scenario and move quickly to policy response. And there, I think there has been a the market has been surprised. I think policymakers themselves have been hesitant in reacting to this crisis in the way they should have reacted. And let me explain that. So if you look at all previous emerging market crises, so go back to the 1980s, debt crisis in Latin America, the 97-98 crisis, Asian crisis, the 95 peso crisis in Mexico, 99 Russian crisis, the 2013 taper tantrum, all of these crises had a particular pattern in the way in which developed. So 2-3 years before the crisis, you have loose monetary and loose fiscal policy, which puts demand in overdrive. The economy overheats, current account deficits widen. They get financed by portfolio inflows that are looking for higher growth and higher returns. And then suddenly there is a reassessment of the risk. In the reassessment of the risk, there's a sudden stop of capital. All of these asset price, that had been, flying for 2-3 years come crashing down. Balance sheets of firms, balance sheets of households, and oftentimes, if it is backed also by loose fiscal policy, the balance sheet of the government gets completely damaged. And because of the damage to the balance sheets, there is an economic crisis, inactivity or growth crisis that follows. There is also a pattern to the reaction in these crises. The first step is to get back credibility in policy making. So what you do is you raise interest rates, you tighten liquidity, and even if the government is not part of the problem, as was the case in the 97-98 Asian crisis, the government has to become part of the solution in trying to put together a cap to overall demand by going through a very steep fiscal consolidation. Then the next step is a recovery step. In the recovery step, the reason as to why you have an economic crisis unfolding is largely because you have a complete destruction and impairment of balance sheets. Therefore, balance sheet repair becomes a precondition to the recovery, which is why you will see in all of these crises, there is debt restructuring, there is privatization, there are mergers and acquisition, which have to be done before the economy can start recovering. And this is a critical difference between all of the crises and this pandemic. But let me finish in the sequence of the response in the other periods. More often than not, neither the initial response of policy credibility nor the restructuring of balance sheets actually managed to get the countries out of the problem. Usually it also requires throwing in some structural reforms. These are typically structural reforms that people have been screaming and shouting for years and are not implemented, but the crisis gives them the opportunity to create the political consensus to put those reforms in. That's the typical sequencing in all of these crises. And we've seen that in almost every one of them. In the case of India, even though they were not part of the global crisis, the 81-82 crisis and the 91-92 crisis had exactly the same pattern. The problem with this pandemic is that the pandemic is not a typical emerging market crisis. The pandemic was not caused because there was overheating. In fact, we would have loved if in January 2019, any economy in the emerging market world was overheated. Instead, emerging market was actually going through one of its biggest slowdowns in the economy. You had the US-China trade war, weighing down on global trade. There was no sign of inflation. Current account deficit countries were actually seeing current accounts actually closing down because no one really was importing anything. Interest rates were being cut, and it was in this environment that the pandemic hits. In the case of India, however, it's even worse because you also have the remnants of a banking sector and non-banking sector crisis weighing down on the economy. And this is where the pandemic hits. And the pandemic changes the sequence in which this crisis happened. It is not that the balance sheet crisis leads to an economic crisis or a financial crisis leading to an economic crisis. It is an economic crisis or economic shock of an unprecedented nature, which if unattended and allowed to go through, will lead to the second step in this adjustment, which is a financial sector crisis. And that is what is going to delay the recovery. So let's now turn to what actually has been done. If that's the policy response, if that's the way in which this crisis is different, we should see a policy response, which is the reversal or the opposite of what should be the policy response in the standard economic crisis that emerging market has seen. And if you look at what has happened so far, the central bankers, to be fair, has been on the forefront of providing the kind of support, both through interest rate cuts, through liquidity support that the crisis demanded. In fact, if you look at the emerging market world among the current account deficit countries, so the Indias, the Indonesias, the South Africas, Mexicos, Brazils of the world, they did something that they have never done in the past. They cut interest rates in the face of massively depreciating currencies. And this is the market obviously was spooked by it first, and then the market finally realized that that was the right response. And so emerging markets started off with a unconventional interest rate policy as a defense, and that was the right thing to do. What has been problematic in all of this thing is the fiscal response. And if you want to look at the fiscal response, the emerging market world, you can divide up into three different groups. One group are the frontier economies, the sub-Saharan African economies, the smaller Asian economies, and the smaller European economies, who not only will see a very large increase in fiscal deficit, but unfortunately, their fiscal deficit their problem is also complicated by the fact that they have very large dollar denominated or foreign currency denominated repayments. And for them, really the only real option is to go to the IMF. Almost all of them have gone to the IMF. They've got the rapid financing facilities, but that is not enough. They will need to go to standard IMF programs, and it is there where the problem is. That if you look at the debt levels of these frontier economies, most of them have debt levels where if they go for any substantial IMF program, under current IMF programs and under current debt sustainability assumptions, debt will not be sustainable. So the IMF needs to change the manner in which it does its debt sustainability. The IMF needs to change the manner in which it actually had the terms of its programs. It has to become much more easier repayment programs, much longer grace periods, much longer repayment periods, and much lower interest rates. So far, the IMF hasn't done that, and unless the IMF does both of these two, I really don't think that the IMF will be able to deploy the kind of resources that is needed in order to keep these frontier economies alive. And that is where we are waiting for the IMF to change. And obviously, the IMF changing its views is basically the G20 changing its views. If you go away from there and you look at the rest of the emerging market world and divide up the emerging market world into two groups of countries, one, the current account surplus.
Jahangir, we'll have to wind up a little bit, please.
Sure, right.
Go ahead.
So the current account surplus countries and the current account deficit countries, the current account deficit countries are the ones that are more interesting. You will find that their fiscal deficits are going to go in the 7-8% range. In the case of India, it was in the 9% range. I'm looking at the total public sector the deficit. It'll go to the 15-16% range. That is true for Brazil, South Africa, India, and all of these countries. And that is where the problem is, that you really cannot go and ask the private sector for 12, 13% of GDP of higher fiscal funding. And there you need the central banks to do what we don't want the central banks to do, which is go out and start buying government bonds in size. And that hasn't happened. I think that is going to probably happen in the second half of the year. And I think in this context, and I will wind down here, Shekhar, I think in this context, this self-imposed 2% of GDP of fiscal deficit, increase in fiscal deficit that the Indian government has imposed on itself looks very, very difficult to have a policy of that kind and the economy to recover. Because all it means is that if the revenue shortfall is more than 2% of GDP, then the government will have to cut overall spending. And if you look at what happened in 2008-9, the shortfall in revenue is going to be several times more than 2% of GDP. That's true for all of these other emerging market countries. It is going to be true for India too. And that is where my biggest concern is, both for emerging markets and India, that the fiscal response is not adequate given the size of the shock and given that it needs to go through in order for the economy to recover. I'm going to stop here, Shekhar.
Thank you, Jahangir. You've ended on a theme that's run through the 4 days on the fiscal response, and I'm sure we'll come back to that. I'm next going to call on Rohini Somanathan at the Delhi School of Economics for her views, and I know that we'll be moving from global very much to the kind of lessons for India from the pandemic and how we have traversed those waters on our jobs and growth challenge. Rohini?
Yeah, thank you, Shekhar. I don't know if I have prescriptions or estimates. I have a few stories. What we did at the Delhi school when this hit was really say, let's talk to as many people as we can on the ground. And what I'm going to do in my 10 minutes is to talk a little bit about this project that we initiated called COVID Vignettes and what we feel we've learned from there. And I'll intersperse what I have to say with some of these stories. And you might take something different away from them from what I do, but I think that's all we have at the moment. The larger thing I'd like to say is that we often talk about growth in terms of macro models and power consumption, investment, exports, trade. But we all know that one of the things that really matters is everything that we call institutions, all the intangibles. Do we trust our neighbors? Do we feel like going to work in the morning? Do we do something that we don't get paid for? Are we going to chip in and help someone when they need something? It's all those things. Do we rely on the police when we call them? And usually these things don't change very quickly. And so our macro models have predictive power. When these macro indicators change, then growth changes. But these other things are really critical for growth. And at a time like this, when all our lives have been shaken up, and ours much less so than many others, then I think we really need to ask how all those other things have changed. And that's really why we started this project. That's why we wanted these vignettes, because we wanted the stories on the ground. So let me tell you a little bit about what I think we've learned. I think the first thing is that there's this trade-off that's posited between lives and livelihoods. It's not just here, it's all over the world. And we're not in a position to know exactly what that trade-off is. We don't have the right counterfactuals. As Jay said, that people made decisions that were quick. They did the best they can. And it's not that hindsight is 20/20. We don't have that hindsight yet. But there's no point talking about mistakes. But it is important to realize that whatever that macro trade-off was between lives and livelihoods, if it did exist, it wasn't true at the micro level for lots and lots of people. So for many, many people, it was more risk of their life and a loss of livelihood. And there was no trade-off. And those were taken for granted. They really suffered in this process. They made the sacrifices. We imposed those sacrifices on them. And I think the very least we can do is recognize that that happened. And that was true particularly of all the migrants. What we did was we interviewed 3 migrants and then we followed them over the last 2 months. One was a tailor who walked from Jaipur to Farrukhabad. There were 2, one in Delhi, one was a rickshaw puller, one was working in a shop. The one that was working in a shop he didn't have the 1,500 that the bus driver wanted as advance fare for him to go home. He went to the bus station, he couldn't get on the bus. And finally, the second 2 took these Shramik specials home. They went on a winding route and took 3 days to get, to cover an 8-hour journey, what would have been a normal 8-hour journey. But they got home and we followed them over time. Some people have sent them money and they're desperate. They don't have work. They can do Narega work. They've never done manual labor. The tailor has never done manual labor. But there is some Narega work available. They'll do the best that they can. They are afraid to come back. So that's lesson 1, that the macro trade-offs don't represent many, many micro trade-offs. We don't have a representative agent. We better be sensitive to distribution so that at least we can be honest. We can say, look, people have suffered, they've had a hard time, it's been terrible, and that's the way it is. And unless we're honest about that, we're not going to move forward and we're not going to learn anything from this experience. The second thing I'd like to say is that trust in local governments and state governments and community organizations has really mattered where it's existed. So we talked to a bunch of people in Kerala. We talked to 2 women who ran what was called a Jahangir canteen. So this was a scheme that was started in February, and we talked to the women who ran the first canteen. And this was just to provide 20 rupee meals for whoever wanted them. It was largely self-supporting, and it was part of the Kudumbashree network. And when the pandemic hit, this canteen was just completely repurposed. So they were giving 400 meals at the local hospital. There were many people who used to go to the canteen when it was a birthday and they would pay a little bit extra. They carried on paying some extra. There were migrant workers who in Kerala were called guest workers who were given meals free. So this was really happening at the very local level. There was no one up there saying, do this. It was happening at the very local level. What was happening at the state level was that the chief minister was talking to people every day for an hour. And the important thing was to say, not, let's get together, we can overcome this, without saying how it's going to be overcome. It was just saying, look, don't be ashamed. It's not your fault that there's not any food. Call this number. If you can't get there, food will be delivered to you. And so it was taking the stigma out of the desperation and poverty that came with the pandemic. And I think that's really been a big part of what Kerala has done. They don't have any more testing kits than anyone else. But they have a system that works because people trust each other. And they trust that the state really does care about them, and it's not just rhetoric. So that's the second thing we learned from our Kerala interviews. The third thing we learned was that safety nets really didn't exist. So even a city like Delhi, where it seemed that the government was really committed to providing shelter and food, people got rations. They got 25 kgs of rice, they got it multiple times, they got wheat, but they just didn't get any money. So they didn't, and a lot of the migrants really didn't have facilities to cook. So for example, the tailor in Jaipur decided to walk when he realized that there was just no food available. So all the shop stalls, when there's a lockdown, they were all closed. So it wasn't as if there was any ability to actually be locked down. And so the risk to their life was considerable. And many friends, it's really remarkable, many friends, many students, many teachers have been working on these community kitchens, just spending hours every day cooking and distributing food. And that carries on today. So people who contribute get photographs every day of the people who've been fed. And the state has done relatively little of this. What the police did during the lockdown is regularly transport people and give them passes so that they could go here and there. But there was very little of actual food that was provided that someone could actually eat. Then there's been some really heartening innovations. So some of our students at the Delhi school go into the civil services. And so they had only a fixed number of testing kits, but they used them innovatively. So they said, okay, we look at where the buses are coming in from, and we'll test people, we'll concentrate testing there, and then we'll look at the first degree contacts and see what's happening and if things are spreading. And they actually managed quite successfully doing this. So there were some people in the IAS who've just done an absolutely remarkable job. That's one thing we learned. There were frequent changes in policies that really hurt a lot of people. So a journalist friend was driving to Calcutta to see his father-in-law who was in intensive care. Everything was fine. They got to Asansol and they were told, no, now you have to get a COVID test because the rules changed. So a lot of pain could have been avoided if things didn't just change every morning. If people didn't feel they got up in the morning and, what is going to be the day, like, what are people going to think today? So I think that, just to close, I think, a close friend and a collaborator of mine, Danielle Allen, who's a political philosopher, has the following to say on the pandemic. She says, the problem lies not with the laws of physics, it does lie with the laws of politics. And I think we need to think hard about that. It's easy to throw a set of numbers down. One thing we did learn, by the way, there are all these programs that are, the Garib Kalyan Yojana, there's all these new programs that have been there. 2 weeks ago, my discussions with district magistrates seem to suggest that the programs on the ground were exactly the same. These haven't yet been implemented. What there is extra food grain, extra Narega allocations, but we don't have, everything that's been talked about in terms of small and medium enterprises and so on, nothing is there as of now, because a few of the migrants that we followed actually wanted to start businesses, and so we tried to check on this. And so coming back to this whole thing about institutions, if we want to trust the state and if we want to trust each other, then the first thing we have to do about the effects of the pandemic is to be honest about it. And Shekhar, all I would say is I just wish I saw more of that, but I don't see it. And I will stop there.
Thank you, Rohini. Those were some very profound issues that you've raised, even though you raised them, as you said, as vignettes. But I think they go to the heart of some of the institutional issues that we've been discussing right from the very first day, including when we looked at health policy and the institutional designs that we need to think about as a result of the pandemic. Let me turn to Ananth Narayan from the SP Jain Institute of Management and Research in Mumbai. Ananth?
Thank you, Shekhar, and thank you for having me, and thank you to NCAER. Very quickly, I'm a pretend academic. I've spent 25 years of my life in a sinful profession of banking. So with the bankers, I pretend I'm an academic. To you, however, I'm going to wear a different hat. I'm going to use the market participants' perspective of coming straight to the solutions and declaring what the solutions are from my armchair here. So the question that you posed, Shekhar, was, what does the pandemic and lockdown what have they taught us about the approaches we need to use for our future growth and job strategy? So my starting point is, frankly, it's not the pandemic so much, but even prior to the pandemic, for many, many years, there were several signs available as to what the issues really are. And frankly, the lessons are more from them than from the pandemic as far as jobs and strategy concerned. We all know the statistics. The fact is we've kind of let our demographic dividend slip. In the previous panel, I heard Dr. N.K. Singh talk about missing the manufacturing bus. It's again well known. Why is it that our worker participation rate is only 35%? Why is it that only 17% of our GDP is contributed by women? Why is it that we have 44% of people, our workforce, engaged in agriculture, which only contributes 15% of our GDP? In terms of output as well, here's an interesting statistic I came across. In the period 1995 to 2005, our trade deficit was about 2% to 3% of our consumption. In fact, our non-oil trade deficit was actually a surplus. It was not a deficit. In the last 15 years, however, the trade deficit has actually averaged 12% of our consumption. So all our consumption, which has been going up, has actually been imported consumption. And this is not just energy, it's not just gold, it also goes into things like electronics, it goes into things like plastics, pharma, into chemicals, and a whole bunch of other issues. So clearly, in terms of both creating jobs as well as output, we've missed the bus and there's a lot to be done. And I'm going to echo what Rohini just mentioned. I think there are two high-level issues that I see in coming out of this morass, in actually creating jobs and output, which I think is the only solution that we need to look at. One is the absence of complete truth, and the second is the inadequate empowerment of the people who need to be empowered. There are plenty of experts, there are lots of solutions already designed by many committees, and I just don't see them being implemented. I'll come back to this in the closing comments. In terms of prognosis of what COVID-19 is going to do to us, at least what I make of it is the following. I think we will see a double-digit contraction in FY21. I think the numbers are there for everyone to see, given the extent of the lockdown, which has already gone through. By the way, this is assuming that by a miracle in August onwards, we actually go back to 100% economy, which is very, very optimistic. I see, therefore, clearly a lot of distress as far as workforce as well as businesses are concerned. By some estimates, as much as 20% of all our 63 million MSMEs could face existential crisis. I also see the level of non-performing assets of the financial ecosystem going up from something like 10, 11% already up to the 18 to 20% of advances. And that's a terribly, terribly large number. It's going to be a huge burden for us. Likewise, I see the fiscal deficit combined, state and central fiscal deficit, as Jahangir mentioned. I see it going upwards of 14% of GDP, and there is already monetization on by RBI. They have no choice. There will be more monetization that will follow. So that's the overall prognosis that we have. So let's look at the short term. And in the short term, there are some good things happening. I think Rohini mentioned this again, the spending on Narega, the fact that we now have food security. By the way, FCI has done a tremendous job of actually procuring food grains. Despite COVID-19, they're sitting on a record 97 million tons of food grains right now, allows us food security, as well as gives money to the farmers. Plus, monsoons are looking good so far, fingers crossed. So hopefully we will see a rural stimulus coming through. More needs to be done, I think, for alleviating labor distress. But I think the place where the relief is missing is more on the MSMEs and businesses. Giving them liquidity by way of a credit guarantee scheme, which, as Rohini mentioned, is not necessarily working perfectly, is one part of the equation. What the industry is looking for is relief on the top line and bottom line. The fact that top line and bottom lines have been so badly impacted. So at some stage, some fiscal relief to them is required as well. And I've heard Dr. Rakesh Mohan say in the past, something like an interest subvention, for instance, for maybe 6 months to all MSMEs might actually make a lot of sense. Sure, you might end up benefiting people who don't need the benefit, but more broader, I think if you give some benefit right now, you'll stave off a lot of bigger problems later on. That's for the short term. I think a lot more needs to be done in terms of relief, but eventually somebody has to pay for all this, and which is where the long term comes in as well. There, I will look at 4 areas which I think need to be addressed, ASAP. The first is the financial services ecosystem. We've been kicking the can down the road on this for a long, long time. We've been struggling to come out with the truth on this. Even now, there is a fair amount of forbearance on banking loans, on MSME loans, on real estate loans. Non-bank finance companies have not gone through the asset quality review that banks have gone through. So there's a lot of gray on what the actual numbers are. We need a lot of solutions around there. The overhang of NPAs is just too large. IBC is good, NCLT is good, but no bankruptcy system in the world in a conventional sense can handle this size of NPAs. We need a one-time solution, maybe a top, maybe a bad bank. Let the experts decide what needs to be done. Thereafter, you've got to take steps to ensure this circus doesn't repeat all over again, which means you need banking reforms to make sure that the way I see it, you need to have babus and netas out of commercial banking, get them out of public sector banking. Likewise, you need governance reforms. Governance issues are ownership neutral. They're across private banks, they're across public sector banks, they're across foreign banks. So you need credit rating agencies, auditors, boards, risk management. We need to be frankly relooked at. So we need a whole governance makeover, and likewise we need a market makeover. Depth in secondary market and so on and so forth. So that's the first big chunk of chunky reforms required. The second one is related to the first one. Specific sectors, real estate, telecom, airline and shipping, power. These are, again, like the financial sector, saddled with chronic stresses, and we are kicking the can down the road and pretending those problems don't exist. Power sector it's crying out for relief and reform. The fact that that your discoms are not collecting what needs to be collected, the fact that many power producers are simply not viable, and they're living on other kind of means. So that entire sector needs to be reformed, as do the other sectors. No more kicking the can down the road, clear that out. But these 2 things are just clearing the mess, though they will not by themselves create jobs and output. Which brings me to the third part. To create jobs and output, you need a whole host of other issues, other steps to be taken to make ease of investments actually come true. What does that mean? It means that people who are closing their ready-made garment factories in Tirupur and opening one in Dhaka need to reverse that trend. You need to have people, when supply chains are moving out of China, instead of India being on the 7th or 8th in the list in terms of preferences, we should be right there in the top for people coming out here. Manish Sabharwal has spoken about all the issues that come in the way in terms of labor reforms. Lots of other issues, and these are cliched words: land reforms, legal reforms, judicial reforms, policy reforms, and ease of contract enforcement and so on and so forth. But the entire ease of investment issue has to be sorted out as well, and that's the big one. No reason why we can't even now make for India and make in India. Make in India might be tough given the global environment, but at least we can make for India in a true interpretation of that Atmanirbhar Bharat kind of situation. The last bit, which is not related to the 3, but I'll refer to the previous panel discussion again, is on the look, we don't know how jobs are going to look like in the next 5, 10, 15 years. Given what's happening with technology, with machine learning, with automation, clearly we don't know what the job scene is going to look like. I think the best we can do, and learning from this pandemic, the one thing we can learn from this pandemic is we have to invest a lot more on healthcare, education, and nutrition for our children. If our demographics is our biggest resource, it's a crying shame that we are spending so little on these three aspects for our youth. Even if you have to eat grass, frankly, we've got to make sure that our children have a quality education, a quality healthcare, and quality nutrition. Once that doesn't guarantee them jobs, by the way, but at least it will equip them adequately to tackle what's going to be a very, very different. I think we don't know what the solutions are. They will figure out the solutions for them once we empower them. So I'm going to stop there. I will just repeat a couple of things. One is I've given this whole, laundry list of issues which calls for boil the ocean reforms. A lot of times when I say stuff like this, I have people rolling their eyes and saying, don't waste my time with stuff which is calling for this kind of boiling the ocean stuff. Tell me what I can do here and now for the next 3 months. Now, here's my grouse with that, right? I've spent the last 20 years listening to this, give me what I can do for the next 3 months stuff. And that has completely lost us this focus on why we've missed out on this entire manufacturing bus and a lot more. Eventually, it has to be about jobs and output. Fiscal deficit, monetary policy, stuff that I write about is useful, is important. It will not solve for jobs and output. Finally, we require real economies, reforms and real hard reforms of this kind to actually create jobs and output. My last closing bit, I mentioned 2 issues earlier, truth as well as empowering our experts. I find it amazing that we simply don't seem to acknowledge the truth well enough, whether it is the level of NPAs, the level of fiscal deficits, the real story behind unemployment. It's almost like trying to do a diagnosis with medical reports which have been sweetened up because they look too negative. Now, how on earth do you get the urgency of getting a diagnosis and a remedy done if you don't have the right medical report? So that's a big issue that I see. The second issue that I see currently as a layman sitting in Bombay, not really knowing what's happening, a lot of the steps being taken right now appear to be crafted by very good bureaucrats. So, the record-long speech that we saw on February 1st from the finance minister, the 5-part, Atmanirbhar Bharat announcements, they're fantastic announcements. Clearly, they include a lot of good suggestions made by industry and other stakeholders, but they seem to have been put together by bureaucrats. We need a good bureaucracy for implementing hard reforms, but I don't see enough political leadership in terms of economic vision, and I don't see enough empowerment of external experts. Maybe we need all 3 together: empowered experts, a political backing for them, and a competent bureaucracy which can implement these boil the ocean reforms. If we get this in place, I see no reason why we can't solve the jobs and output conundrum for us. Back to you, Shekhar.
Thank you, Ananth. Again, you've harked back to the institutional issues that seem to be at the core, but also the trust issues and the data issues that I think have also pervaded the 4 days of discussion we have. To close out this panel, and I see that we are reasonably good on time, so we should have a good period of time after our final panelist to open it up to discussion, and several hands are up. But I would like to call on my good friend and former co-worker Junaid Ahmad, Director of the World Bank in India. Junaid?
Thank you, Shekhar. I must say it's pretty daunting to be the last speaker of all of your series and to be the last speaker after what I think between Rohini and Ananth, I think the messages are very clear. So with apologies to everyone, I don't want to try and repeat and share with you at least some of my perspectives. And allow me to share perspectives as a economist who's been in development rather than necessarily share a perspective as an employee of the World Bank. If you can allow me to keep that separation, it may be a little bit easier for me to say a few things that I'm about to say.
You are given full license, Junaid.
A month back, one of my colleagues came and explained to me that we couldn't go ahead with procurement of ABC medical supplies in the context of where the procurement was being done. And I looked at my colleague and I said, you're asking me to apply rules that were set for a normal world in a context where the world has completely changed. I cannot accept your answer that we cannot do this procurement. So I took the risk and I overturned most of the World Bank's procurement rules to say, let's go ahead and do that. Let's go ahead and repeat. I use that as my vignette to say that today, the state is fully back in the game and has to be back in the game in the context of the type of growth shocks and the type of poverty shocks we're seeing. I think people have to recognize that the traditional macroeconomics and the traditional metric of how a state functions, I don't think apply anymore. We're talking about a fundamentally different set of rules of the game of what the state needs to do and how the state must work. The state is the big player here that can get us out of the mess we're in or go deeper into the mess. And I don't mean the Indian state, I mean state in its broad term. And I don't think we have thought through what that means for macroeconomic policy, because I don't think the rules of macroeconomics apply. I'm often asked, what do you think the credit rating agencies or markets will say if budget deficits go up to 10, 12%? And I say that it's absurd to apply the rules that we had on around a world quote unquote normal and apply them today. I, for one, believe that the state must go in much deeper in terms of expenditure. I believe the state must spend more and the deficits must be much higher if need be. And I am also of the belief that there are different ways of managing that. So I think my first point is for us to sit here and talk about macroeconomic policy and economic policy as if the world has not changed is really putting a shame to our discipline of economics and policy making. It's a very different world, and macroeconomics for sure has to be very, very different, right? Completely different. That's my first point. My second point is, please recognize that COVID has not disappeared. COVID still needs to be addressed. And in addressing COVID, I think we have to recognize that unlocking India means unlocking urban India. That there are 10 to 12 urban agglomerations where if we don't stop COVID, we're not going to be able to unlock India. But what does it mean to unlock urban India? It means an urban public health system which currently does not exist, right? How do you create an urban public health system is the demand of the day. And here, I think we come to a point, which will be my third point, that COVID has revealed the fault lines. And if those fault lines are not corrected, you're not going to be able to really lift off. And those fault lines, as Ananth, I think, correctly said, existed before. They were not created by COVID. COVID reveals them. And urban is one of them. India is one country that is still seeking an urban paradigm, an urban political economy paradigm. Around the world, you have paradigms of strong mayors, or you have paradigms of strong city managers. What's common across both those models, one sort of countries in the West, many in Africa, and the city manager model is coming out of East Asia and a lot in China. Both these models have the commonality that cities are managed at the local level in an integrated way, and accountability is at that local level. And I think that if we are to look at India, indeed South Asia, my own country, Bangladesh, we run cities and towns in a vertical way, so vertical systems and fragmented. In that context, you will not see rise of a urban public health system, which is desperately needed. A public health system that's able to do community surveillance, community response, rapid isolation of hotspots, direct communications. That's at the local level, and it's an interface between the local state and the citizen. fundamental rethink of the municipal public health. And I think that would be my second point. My third point is the one that these fault lines, and these fault lines suggest that India has to do what it has been on a path to do at its own pace and has to be accelerated. Number one, the future of India lies in the states of India. The future of India lies in its federalism. And the federalism and its functioning is essential for reestablishing a new relationship between the state and its citizens, because that's what is now going to be needed to go forward. It requires an empowerment of states so that different states and their local bodies are able to respond to their local conditions. And this is an extremely important shift that I think is going to be critical for dealing with future pandemics, future shocks, because I think COVID-19 is the beginning of, or is the announcement that we're now moving into a world of shocks, whether it's going to be climate change, whether it's going to be the demography, which is changing around the world, or more pandemics. It's that federalism is going to have to come out in a much stronger way. And I think that linked to federalism is the whole rethinking of the social protection system in India. It's a highly rural system, and what India now needs is a pan-India system and a pivot into an urban social protection system. Future of India, not only in the states of India, but it'll be in the cities of India. You need to protect the urban informal worker, be they migrant or not, that the social protection system has to pivot into an urban system. And you have to have a central framework which then catalyzes and empowers the state and local systems to respond. Without this kind of rethink in terms of social protection, the future shocks are not going to be managed. And I guess for me, the issues that have been mentioned, financial sector or the agriculture sector, all of these that were on a slow trajectory of reform now has to be accelerated, because it's at that real sector level that you're going to find that you need the changes. So I guess my sort of reflection is, if we haven't recognized that we are in a completely different world in which the relation between state, policymaking, and citizens have to be rethought, then we're missing the point of what is happening. And I do think that also reflects on the international Bretton Woods set of institutions. I think that Jahangir talked about how he would like to see the IMF shift its rules of the game. I think it's deeper than that. I think we need to relook at whether or not the Bretton Woods systems actually were ready to deal with these kind of shocks. You know, we're very proud that we've put about $50 billion into the global economy, and we expect to put $160 billion in the coming 10 to 12 months. And that's an important issue. But I do ask myself, did I anticipate this shift as a member of a global institution? And the answer is no. Did I react to the shift? The answer is yes. I think we need a completely different rethink of global institutions that are going to be able to be proactive in understanding shocks that are coming. And there's quite a bit of writing that has now emerged on how you rethink global institutions to deal with global shocks rather than this proactive country by country reaction. So bottom line, it's a different world. It's a different relationship for the state and its citizens. And I think that unless we deal with it from that perspective, we're not going to be able to solve what I think are fundamental issues of growth, equity, jobs that are there. That's what I take away from the last several months of what I've seen globally. Thank you.
Thank you, Junaid bhai. That was, again, and I'm glad you ended up with the Bretton Woods institutions, because that will be one of the things that will be watched very carefully and will have a huge influence not just in South Asia, but particularly in sub-Saharan Africa. So we are in reasonable good time. We may stretch a little bit over. I see a number of hands up, and I'm going to call on people and request them to be really very brief so that we can get a chance to have as many points of view and questions. So, Shudipto?
Thank you, Shekhar. Can you hear me?
Yes, we can.
I'm going to ask a question of Jahangir, but before that, let me say that I really enjoyed listening to the presentation of all the panelists. They were excellent presentations. Particularly enjoyed those very insightful narratives from Rohini. Jahangir, again, thank you for a very, very neat presentation. I have two kind of related questions. You mentioned at some point, Jahangir, you mentioned at some point about some policy limit of 2% of GDP that the government had set itself and so on. I don't know where you got that because I haven't heard anything like that, unless you're referring to the extra borrowing headroom of 2% given to opened up for the states with some conditionality and so on. I don't know, I'd just like to clarify that. Because as you yourself said, and we all agree, you're really looking at a PSBR of about 14, 15%, which is a different ball game from the kind of thing that used to happen, and that's what we need today. The specific question I had is we by the way at NCER have just suspended forecasting because we think there's too much uncertainty to do any credible forecasting. We look at scenarios, but you mentioned that you're looking at something like minus 6.5% of GDP growth for the current fiscal, which would translate into a GDP loss of about 13 trillion compared to last year. The question I had is this after factoring in the fiscal stimulus and the monetary injection, or is it a counterfactual without that?
Sure.
So that's
Sure.
very
So Jahangir, could we wait and let's take a few more
Sure.
questions together and then we'll deal with them. I had Rajeshwari next. Rajeshwari, I think you're muted. I'm not sure. We can't hear you anyway. Rajeshwari, we can't hear you. No. Am I the only one who can't hear her, or? No, we're all having difficulty, Rajeshwari.
We can't hear.
Let me come back to you. Why don't you see if we can fix this in a second, and then we'll come back to you. Karthik?
Can you hear me? Yeah, so thanks for an excellent panel, and just wanted to say a couple of things. One, of course, just making a replug. I think for the points I was making yesterday on a simple approach to support all of these points based on social protections, inclusive growth, dividend. I think we all understand broadly what needs to happen, and just to make that plug once more, I think there's very broad support. The idea of a 1% unconditional cash transfer, income transfer into a bank account, I think many people in this panel supported. It would address some of these issues Rohini was talking about directly, right? The empowerment, the agency, the portability, and there's just so many reasons to do this. That was true even before the crisis. Maitresh and I wrote the IPF paper on this last year. I think I feel even more strongly about it now. I think my main question. And in fact, the thing is, the interesting thing is, Panda himself is in favor of these income transfers. The Prime Minister's kind of instincts, I think, are in that direction as well. So I think the main issue goes back to what the markets are going to say, what the bond markets are going to say. And I think the expenditure secretary was in the session yesterday, and he was like, there is a good case to be made for the borrowing, but at the same time, the credit rating agencies are, downgrade. So my main, I guess, question to Jahangir and Neelkanth and others is, to the extent that part of the government's ambivalence seems to be driven by how the markets are going to react, would it make sense for the markets and the World Bank and other kind of providers of credit to actually lay out certain guidelines to say, here are the kinds of spending that we think, are warranted because this will more than pay off in terms of the overall economic recovery, that you're not going to get a credit rating hit, and conversely, not doing anything is going to make things worse because the denominator is going to fall. So I think maybe clear unified messaging of some sort from the markets may help. And I think, Junaid, the second point, and this is a particularly fraught moment for India because you and I have talked, over the past 2 years about, the centrality of state-led leadership in a whole bunch of reforms that we've talked about. And as you know, I've been working very deeply with some states. But I think the crisis has come at exactly the wrong moment because the instruments that you need to fight a war like this, the states don't have those instruments, right? So the RBI is with the government of India, borrowing limits are set by the government of India. So the one concrete idea I have here is that to the extent that the government's approach to supporting the recovery is through credit, because at least on the balance sheet, it doesn't look like you're giving away a large amount of money, and that you'll account for it later when you have to write down some of this. So the approach even to the economic recovery, MSMEs, has all been credit, but that credit is not being taken up. So if you look at the real economy and saying who has shovel-ready projects that can be done, it's the state governments, it's state and local. And so the concern here is that the shrinking of the state revenue base is also going to create further a downward spiral by kind of forcing states to tighten. So the question is, given that the credit default risk of states is pretty low, as Neelkanth wrote a paper for us at the IPF 2 years ago, partly because of the RBI mechanism, does it make sense for the World Bank to talk to the Ministry of Finance and saying the bank is willing to offer a certain amount of additional untied, low-cost credit to all the states as another way of financing to tide this over in a way that doesn't affect your credit ratings? Because I think part of the challenge here is exactly like you said, the solutions to these things have to be local. And right now, my concern is that there is both lack of capacity, but also just lack of instruments for states that want to show leadership to try innovative ideas because they just have no fiscal space. And so maybe that could be one useful way to try and, instead of focusing all of our conversations on Delhi and hoping that somebody's listening, what can we do as kind of a broader market and development community to further empower states in a way that allows more models to emerge?
Having been around in the bank at one point when there was a state-oriented strategy for bank lending, I'd like to entirely support what Karthik just said. And perhaps we do need to create a bit of a competition. This is not the time for such competitions, but certainly those states that are willing to take steps in this direction. This could be a very important suggestion, Junaid. I have, I have Raghu next. And then I have Pranab and Rajeshwari is back. Raghu?
Just on the numbers, maybe Jahangir or Ananth, both of whom gave us very nice presentations, could elaborate. I mean, there's this feeling 14-15% of GDP, this is what everybody else is doing. But clearly, it has a lot of components which are not about repair, relief, or stimulus. One, the GDP is falling. That's going to add to the deficit. Two, revenues are falling. That's going to add to the deficit. And that revenues could fall just because people aren't making any money and not paying taxes, not because it's some kind of stimulus. And of course, the existing deficit, properly measured, was about 9 to 10% of GDP. That's what JP Morgan has said. So how much is the additional amount? And the 20 lakh crores we keep banding around, that's rubbish. Come on. 20 lakh crores consists of a lot of counting, which doesn't count as a fiscal deficit or stimulus or whatever you want. For example, 7 lakh crores is RBI liquidity, which is essentially the financing of the deficit rather than the additional spending itself, right? So we have to be careful about the proper numbers. And so how much, in your view, is the additional spending that is taking place if you parse everything down? And again, I think it would be helpful if, given your perspectives as people who work from the private sector, how much additional is possible at this point without perhaps totally impairing our future fiscal path. And to some extent, that path is also endogenous, right? We can do things to make that path look a lot better by enacting institutional reforms now that give us more space. So what kinds of reforms could we do to give us that space?
Thank you, Raghu. Pranab, I just wanted to say that we are 7 minutes from our scheduled close, but I do believe that we were about 7 to 10 minutes late into this session. So with everybody's permission, I will extend this session by that much, and then we'll do a closeout with Karthik and Barry and I. Pranab, please.
Yes. Am I audible? 2 or 3 points. I enjoyed all the presentations of the panelists, but let me particularly compliment Rohini's presentation because that was different from the others. She was giving us touching stories from the ground level. And those, by the way, those stories, I have heard some stories myself. Those stories are quite consistent with the stories that I have heard. What is interesting is the big dissonance between what these stories are telling us and the data that are being put forth by the government and by today we had our friend Panda, the way he mentioned about data, or the expenditure secretary, the other roundtable talked about some data. The dissonance is really interesting. Now, one dissonance is already come up, and I just wanted to mention that I fully share what Raghu just said about that 20 lakh crores, which really, in some sense, is quite meaningless to go on repeating about. But there's another kind of data which the expenditure secretary Somanathan brought about. Those are about particular measures, how much have reached the poor, etc. There's something that we could not discuss that day. I think I just want to mention one problem with the administrative data is that either they're government data or data collected by consultants of governments. The way they are doing it, as Mr. Somanathan said, they're collecting the data from BPL households. But one big issue is that because of the lockdown, so many people lost their jobs and incomes. People who were not BPL before are now BPL. But most of these surveys are not capturing them. Most of these administrative surveys are not capturing them. They start with a predefined list of BPL households. So there's a big gap in people they are not being able to capture. That's my point number one. The second issue I'm going to talk about is the employment issue, which is the topic of this panel. Employment, of course, the main issue is with the MSMEs. And if you think about the MSME, the government has not even addressed most of the MSME. If I remember the finance minister's speech in May, coming out with the second package, she gave a number. She's addressing, I think if I remember right, 4.5 million MSMEs. Those measures, whether it's actually reaching them or not, is a different question. But 4.5 million. What is the total number of MSMEs in India? 63.4 million in the last count. So that gives you the quite kind of gap one is even addressing. Ultimately, the money is not reaching there. I can just refer you to 3 or 4 weeks back, the Manufacturers Association came out with some numbers. One number I do remember is that already 1/3, at least 1/3 of the MSMEs are beyond recovery. They have reached a stage you cannot, you have waited for 3 months, 2 to 3 months for even announcing the measures. By that time, most of them, many of them, 1/3 of them have become beyond recovery. On the employment, I just want to make 2 other points. On the employment, I'd like to know, I haven't seen any discussion over the last 4 days of employment policies which have been tried out in many countries, both rich and poor, but India has not tried that, is wage subsidy. In other words, and this is for the formal sector, and I'm not that you don't lay off. In order to induce employers not to lay off, you give them temporary wage subsidy. But the biggest wage subsidies are in countries like France, etc. But also I see accounts of many developing countries who have tried wage subsidy so that people are not immediately laid off. So the employers are funded by the government. I would like to know what people think about wage subsidy. One problem in the long run, of course, is that wage subsidy, if it persists for a long time, it might also encourage zombie farms. Farms that should not be there will be there because of wage subsidies. The other problem is fake payrolls, but that can be with Aadhaar, etc. That can be taken care of. The other, where I would like to know the panelists' opinion, quite often it has been suggested, at least in the short to medium term, why not start urban public works program, or like the rural NREGA, some employment programs in urban sector, because much of the urban poor have not been addressed by most of the government measures announced so far. My last point relates to the federalism point Mr. Ahmad mentioned, but particularly something that has not been discussed so far over the last 4 days, but I've seen some discussion in working papers by the Center for Policy Research, is that in India, well, first of all, most of the battle, the states are at the forefront of the battles, not the center. Yet they don't have the money. Now, in the short run, how do you push money to them? One is, of course, giving, as the government has announced, borrowing limits, but I think that's mostly non-functional because the conditionalities that have been imposed, some of those conditions, for example, one of the conditionalities of extra borrowing is power sector reform. Now, something that we have not succeeded in 2-3 decades, you cannot just now do so that you can borrow more. So forget about those kind of conditions. Those are more like hype rather than actuality. But problem is, so they need the money. One of the big issues, and this is what comes out in one of the Center for Policy Research working papers, is that India, even if the center wants to give them money, there is no institutional mechanism through which you can give them emergency help. You can either do centrally sponsored schemes, which in any case are probably going to be suspended because of the budget cuts in ministries, or finance commission transfers. So so the institutional mechanism needs to be installed. One of the suggestions is to use the interstate council, but there are problems there. But let me stop there. I don't want.
Thank you. Thank you, Pranab. We are running short of time, so I still have 3 hands. I don't want to not let them have a go at it. Let's do Rajeshwari because you were trying to get in, and then I'll just take 2 more, Shomya Kanti Ghosh at SPI, and then Anupam Khanna, and then we'll have to cut it off there and give a chance to some of our panelists to come back. So, Rajeshwari.
Thank you. Am I audible now, Shekhar? Okay, perfect. I lost my position in the queue, so therefore I lost some time as well. But nonetheless, I'll try to keep it brief. So my first question is to Jahangir. That you mentioned about fiscal policy. Since the days of FRBM, we haven't really had a serious fiscal problem in the sense that the debt to GDP ratio has almost always been around 70%. But now this year it will surely increase to 80%. And in some projections that I'm doing with Ila Patnaik, we can see that in the medium term, the debt will keep rising to 90% if the fiscal situation is not brought under control. And if growth doesn't revive quickly, especially given the productive capacity might get affected. So then the problem is if the debt gets too high and people refuse to hold it, then the interest rates will soar. and then we can quickly go into a fiscal crisis. So I would be interested to know what is your take on that, notwithstanding, of course, the fact that in this unprecedented scenario, we need fiscal stimulus. The second question is either to Junaid or Rohini, whoever chooses to answer. It's more like a comment that I may be wrong, but I think to solve a problem, we first need to acknowledge the existence of it. And so far, whatever we have heard from the government is that the mood seems to be that by and large, we are doing fine. We have taken care of the migrant workers, we are distributing food, we are giving money through Jan Dhan accounts, we're even declaring a premature victory on the health crisis. So is there even a recognition of the larger problem? For example, the problem with the firms, the banks, jobs, demand shock, supply constraint, the whole laundry list of issues that we are having, or a political will to solve the problem? Because if that's not there, then basically we can just keep kicking the can down the road for a very long time. The last and third question is to Ananth.
You'll have to be brief, Rajeshwari. Go ahead,
fine.
please.
Sorry, I'm really sorry, Ananth. So Ananth, the question is, you did mention about this kicking the can down the road, but we have suspended IBC for a year, the bankruptcy law, and we have declared a moratorium for 6 months. There will be large-scale corporate bankruptcies, and there is no resolution framework in place right now. In that situation, how do we avoid going back to what we did in 2013-14, which is having the same kind of restructuring schemes and pretending that the problem does not exist? And then again, a few years later, we do an AQR and we find the problem is really severe. And it seems history is just repeating itself over and over again. So I'll just stop with that. Thank you.
So that's a very appropriate point to bring in Soumya Kanti Ghosh. Soumya?
Yeah, thank you. I have a comment and a question. The comment is basically, I think there has been a lot of discussion about this moratorium and how it's going to impact the bank quality. I think there is one point which is coming out very strikingly during the crisis is that there has been a significant amount of deleveraging which is being done by the consumers. So whether it is because of a job loss or whether it's because of a pay cut, but I think that's very visible. That happened in April, that happened in May also, if I look into our data. So the positive part of that, if that continues, so that could be a sobering impact on the moratorium as far as the retail part is concerned, but the consumer, the recovery will be delayed significantly and beyond. So that's the first part which I want to mention. The question which I'm going to ask is that, I think Ananth or Jahangir, anyone can answer this, is that, I mean, we have been talking a lot about this rural recovery right now. But let me give you some data. I think the problem with the rural sector, and you always aggregate the rural in India with the agricultural sector, which is actually not the correct way, because a large part of the agriculture is now allied activities. I think if we actually look at the food grain production data over the last 5 years, the CAGR has been 4%. So it's not that we have been producing enough food grains. But if you actually look into the agricultural price deflator for the last, I think, 6 to 7 years, that has been only hovering around 1 to 1.5%. In some of the quarters in the last 2 years, it has been significantly negative. So the point which I want to mention is that as long as you are not able to transform that food grain produce to adequate purchasing power on the part of the rural livelihood, or also because there is not enough demand in the urban sector, I don't know whether, I mean, that rural recovery will actually gain traction or will have any importance in the current scenario. I will end here. Thank you.
Thank you, Soumya. And then I'll give the last question to Anupam, and Anupam will have to be brief.
Yes, thank you, Shekhar. I first strongly endorse Junaid's point about basically to lock up the macroeconomists. I would say also the microeconomists, because at best they're a distraction. And especially, I think I find it troubling when people say, don't waste this opportunity. Unless we address the immediate problem, which I consider going over the next 6 months, we won't. And does the group feel there are some sensible economic remedies to address the so-called smart unlocking? I think Pranab has mentioned 2 or 3, and I'm surprised at how little of that discussion is taking place, especially in India, whether it is wage subsidy, whether it is urban public works. Things like social protection and federalism will need to be thought through. But what can we do to, both from a public health point of view, unlock, and especially in the urban areas? And I think beyond wage subsidy, etc., there are some targeted, ways of getting people back to work without compromising the health risks. And I'm surprised at how little of that discussion there. And I wish we could have some economic insights into it. I don't have time to delve into those, but I'd like to hear from the others.
Okay, so we are at 9:38. With your permission, I will take this to about 9:50. Yesterday we went beyond 10. I'm particularly concerned about those of us in India who probably haven't had our dinner as yet. Rohini, why don't you come in first? I think there was a lot of empathy and simpatico kind of sense about what you had to say. And clearly it was the most unusual of the contributions. Rohini.
Yeah, Shekhar, the point that I found really important is the one about federalism. So Pranab said, how are the states going to get the money? What's been really worrying in the last few weeks is it's clear that the center doesn't want to give them the money. So the way that they would get money would be through central schemes that went down to the states and from economic activity. And it was very clear Kerala was managing the pandemic fantastically. They had 0 cases and they wanted to open up districts where they had no cases in 14 days. And they got a letter from the center saying, you're not allowed to open it up. This is a violation of the lockdown. And what was really remarkable, I think that this is leadership at its best, is that Kerala Chief Minister saying, we're very sorry, we didn't realize you don't want us to do this. We backtrack and we'll close them. And it was really because, I don't know what was going on in Kerala. This is only what I read in the newspapers. But to me, it was obvious that this is someone who realizes that we're completely dependent on the center. The last thing we want to do is to, block whatever we could get from them. Both in terms of overdue GST payments and anything else. I think the one really good thing that this government has done in its last tenure is the GST reform. I think that that is one way that the states are going to get money, but it relies on economic activity. The other thing that I want to say, just because it hasn't been said enough, is there is a lot of damage we find in our stories. There is a lot of damage that has been done by the anti-Muslim sentiment that has been generated by this whole Tablighi Jamaat meeting. There was no, I got back to India on the 13th of March. Nobody told me that I was not supposed to do anything. There was no question of a lockdown at the airport at the time. This meeting was on the 15th. There were many, many meetings that were going on at the same time. But both the official statements and the subsequent media attention has sent ripples through the economy that have been very damaging. So the Muslim tailor that we followed said, there are many villages linked to this Kasbah, but now the Hindus will not give me work because we've been trying to say what you'll get now. Vegetable vendors have not been allowed into Muslim apartment complexes. And so I think when we get mixed up, we keep going from big things to little things, and that's natural because so much is changing around us. But we just have to step back and say, what is in the Constitution? Federalism is in the Constitution. Protection of basic rights is in the Constitution. Let's first talk about those, and then let's talk about other things. And I think those have been violated in, just incredibly so, more than I would have ever believed. So I think there are plenty of ways. We want to change it so that the states have more money, but there's still plenty of ways that could be done in the existing system. But the problem has been that they don't really want to give states the money. And that's been completely obvious to anyone who's just been looking at the daily newspapers every day. And, I'm not against the government at all. I'm just against a lot of the things that have been done and the whitewashing that's been done. And unless I say that openly, I'm not going to be able to appreciate something that they do tomorrow that's actually good. I'm annoyed, but I think I'm glad to have this opportunity to express that. It'll make me less angry.
Thank you, Rohini. And speaking truths to power is always a good thing to do. Let me see. Jahangir, do you want to quickly take, and it'll have to be really quick, quickly take some of the questions that were posed to you?
Yeah, sure. So thanks for the questions. And I'm going to take Sudeep, Raghu's and Ayush's questions together. So answer to Sudeep's questions, where do I get the 2% of GDP number? That's basically what the RBI as a debt manager has said is going to be the increase in borrowing from the government. So I'm assuming that's the current line in the sand. The line in the sand might change. Now there's a broad question that both Raghu and Shrita asked about the fiscal impulse, whether my forecast of 6.5% is included, and whether or not more generally is there any fiscal impulse. So let me be very categorical. There is no fiscal impulse in India. There is no fiscal support in India. There is no fiscal support in any of the current account deficit countries. So if you look at the actual revenue shortfall that is going to take place, we are at best holding expenditures at the same level as the budgeted expenditure. So all COVID-19 related excess expenditures are being assumed to be offset by cuts anywhere. If you look at why that is the case, so if you look at the usual, tax elasticities, in India's case, I will use India as an example, is 1.2. The only difference is that what happens when there are large shocks to the economy. So shocks to the economy, let's say they're larger than 4 percentage points of GDP, that tax elasticity goes from 1 to about close to 3. And this happens because when there are large shocks to the economy, not only does the incomes fall and therefore the tax on those incomes fall, but more importantly, the tax base shrinks because a large number of households, large number of firms go below the tax threshold. And this non-linearity, I don't really think that our fiscal authorities are actually computing when they're computing the fiscal listing. So to Raghu and to Sudipto, there is no fiscal impulse. In fact, we are looking at a fiscal drag in the proper sense of the term, in properly defined in 2020. To the point of Rajashri, why is it that, why has life been reasonably easy for India over the last 4 or 5 years, even though public sector borrowing has keep on going up? It's the old formula. It's the difference between growth and interest rate. In India, even today, we do not pay the 10-year bond, which is the government's basic instrument of borrowing. The interest rate on that is still lower than nominal GDP. This is what happens if you have financial repression. If you have financial repression, you are basically taxing households and funding the government. You just don't want to call it taxation. You want to call it something else, but it's basically financial repression. This year, the financial repression turns the other way around, where interest rates most likely will become higher than nominal GDP, and that's the reason this year the fiscal deficit will go up. There's just the last bit on what is that the market is looking for. The market isn't looking for a 2 percentage point or 1 percentage point of lower fiscal borrowing this year. Everyone knows this is an unprecedented shock. You need unprecedented support. No one is disagreeing with that. Everyone assumes that there is going to be a massive amount of quantitative easing, massive amount of bond purchases by central banks across the globe. No one is denying that. What people are concerned about, and this is where the rating agencies come into play, what people are concerned about is that, does any of this assure a recovery to medium-term path, to the old medium-term path? And this is where most of the concern is. So I'm going to end by giving you a natural experiment that happened in India. So, there were 2 rating agencies in the last 1 month who had 2 completely different views about India. So one rating agency goes and downgrades India, albeit that downgrade wasn't really that big of a downgrade because it went from 1 notch above investment grade to the next notch. So the India still remains investment grade. And the other rating agencies went and reaffirmed their investment grade rating. If you actually, go and look under the hood and look at the details of it, there is absolutely no difference in any of those or any of the 2 rating agencies' assumptions about fiscal deficit, growth in 2020, growth in 2021, revenue, nothing. There is only one difference. That one rating agency, the one that downgraded, has in the medium term for the next 5 years a nominal GDP that is 1.5 percentage points. That's it, 1.5% lower than the nominal GDP of the other rating agency. The one rating agency that had the higher nominal medium-term GDP confirmed the ratings. The one with the lower one downgraded it. At the end of the day, rating agencies are not, looking at 2020 fiscal deficit and saying, "Oh my God, this is massive." It is going to be massive. Everybody's accepted that. What people are looking for are the reforms, are the policies enough to put back these countries back on a medium-term growth path, and that, and only that, is where most of the concerns lie. I'm going to stop here, Shekhar, and let Ananth answer the rest of the questions.
Ananth.
Thanks, Shekhar. And yes, Jahangir has done a bit of the heavy lifting. Let me add a couple of points to the fiscal deficit numbers, what Dr. Rajan asked as well. I think Karthik also mentioned this. Clearly, there are assumptions here. The assumptions we've made, Dr. Rajan, are that there'll be a reduction in obviously revenues by about 4% of GDP. I have penciled in 1.5% of net additional spending by the government. I'm assuming that while they are doing cost cuts and stuff like that, that they will do more. And I'm genuinely hoping that more relief will come to the MSME sector specifically, and some of the other stuff that Dr. Bardhan also mentioned, relief for the people, etc., will come through. And there's about 0.5% of GDP of impact because of the lower GDP numbers, the denominator itself going down. So that's where I get. By the way, the last year's numbers shown of all the smoke screens of off-balance sheet accounting and not paying the private sector, etc. Center and state was probably 9.6% of GDP already. And this is not even taking PSBR. This is just pure center and state, deficit. So anyway, so that number could go well into the range that Jahangir mentioned, 15% plus. And what Rajshri mentioned, I think separately, which that debt to GDP could go up to 90% of GDP, I think is absolutely possible over the next few years. Now, the larger question that you asked, how much space do we have? And I'm going to give a very naive answer here, and apologies for that. And this, I guess, addresses Karthik's point as well. Look, I'm seeing this as a practitioner. How does a fiscal deficit hit us? How does it impact financial stability? I see two transmission mechanisms. One is, inflation, obviously. If there is velocity of money and you're creating M3, you are going to create an inflation problem. And the second is the currency, which means if you're not producing enough and your consumption goes up and you start to import more, then you have a currency problem as well. Now, both of this seem muted for now. Clearly on the currency side, for the wrong reasons, we are running a current account surplus right now. And with FDI looking good as well, the currency problem seems to be a 1 year later problem. It's not a problem for now. Inflation, by the way, is a bit of a worry for me. While at the moment there is no demand-led inflation, clearly the urban population is not spending. We have to realize that a lot of our consumption basket is essentials. And particularly if money goes into the rural hands, and we've seen this in 2010, 2013 as well, when money goes into the rural hands, you can actually see food inflation, protein inflation go up. You can actually see essential demand go up. And you could have a very paradoxical situation a year later where you actually are grappling with a stagflation kind of a situation. I hope you don't go there, but I do worry about what could happen to inflation going forward. What we can use to pay for all of this, I think the simple answer for that is straightforward. It is creating sustainable jobs and output. Both have to go together, right? Which means that it's not enough if we give jobs in Narega in the long term. Of course, for now, we have no other choice. We have to give Narega. But eventually, it has to be jobs which is accompanied by output as well. That output has to match the additional demand created by creating jobs and by giving money out. If we don't create that demand, what's going to happen is we're going to have too much money chasing too few goods and protein inflation, for instance, or what we're doing currently, which is import a lot of stuff, either as intermediates or as finished products. And therefore, our current account again goes up and we start to have a financial stability problem. So eventually it boils down to creating what the topic of this panel discussion is, which is jobs and output. When I go back to my point about medium-term framework, you cannot solve this by Excel spreadsheets of fiscal deficit and monetary policy. It has to be real economic issues sorted out. I think Dr. Bardhan said, power issue can never be sorted out. Now is the time to start thinking about it. I know it won't happen the next 6 months, but over the next couple of years, can we find a solution which works? I think that's the time to look for it. Very quickly on IBC suspension, Rajeshwari, you asked that question. It's a great point. Here is how I would see it. First, there are a lot of issues which predate COVID-19. So you had cases which were pre-COVID-19. I think there is where you can continue with what I hope will be a one-time approach. I know there are lots of arguments against it, but I still like something like a bad bank or a TARP approach to take care of that huge. We need something to quarantine those assets away so that the rest of the financial system can think about getting back into the business of funding India's growth. So I'm still hoping for that, at least some kind of process can continue. I'm okay with a 6 month to 9 month, or as long as the medical situation doesn't improve, some kind of time frame for giving breathing room to MSMEs. Now, normally what would have happened is if our financial sector was better off, it would recognize the fact that many businesses will face issues for the next 3-6 months. But eventually, when system comes back to normal, things will become okay. So they would have done the financing themselves. The problem is our financial sector is extremely weak and therefore not in a position to do that financing right now. So giving some space of 6 months moratorium / relief, I look the other way, I'm okay with. But your point is absolutely right. We can't let this become another 2012 case where we have this House of Debt report from Amit, which says the whole place is blowing up, and you eventually recognize the NPA only in 2017, 2018, which makes no sense at all. So that's the point there. On rural economy, Shomo, very quickly, you're right. But here's how I see it. Agriculture is only 15% of GDP, fully understood. A combination of agriculture hopefully having 3, 4, 5% growth this year on the back of good monsoons and other favorable conditions. You're right that FCI by itself doesn't put money, but to be honest, the government has done a great job of actually procuring money through FCI. They actually started 15 days late on FCI procurement. Normally starts on April 1st. It started April 15th. But they increased the number of collection centers, and which is why we are at all-time records in terms of food stock right now. So some money has gone to farmers, and it also gives us some room, of course, for that food security coming through. So I'm hoping that a combination of all of this, plus the other prime ministers, whatever it's called, Grameen Yojana, et cetera, some money going through there, I'm hoping will give some impetus. Now, here's the other point. At this point in time, given the fear factor in the urban centers, I don't think money consumption will actually happen out here, or any kind of real consumption will actually happen out here. So to that extent, the rural economy is the best bet, even though it's a good question, why the hell are you giving relief to the rural economy when it's the urban economy which is so stressed? I agree with Dr. Bardhan that you do require some urban employment program as well. But I still think any impetus you're trying now has to be in the rural sector. Hopefully that will provide some demand, and 45% of GDP is not comfortable. I'll stop there. I've taken too much time.
Thank you, Ananth. Junaid, last word.
So first on the question of the World Bank and lending to states. So Shekhar, you may not have been following us anymore since you left the club. 60% of our lending is directly to states, paid by the states themselves, back to back. And if you take into account the multi-state programs that we're doing, it'll be about 65, 68%. So we're directly to the states. I think federalism is one of the big issues. And one of the areas that there is a need to rethink is the flow of the centrally sponsored schemes. I think the centrally sponsored schemes remain too rigid. I think moving them towards fiscal transfers, conditional fiscal transfers, which means per capita block grants to states, would offer the type of resources so states could take them forward in terms of implementation. So instead of designing, for example, an education program or a water program in the traditional centrally sponsored scheme, one gives a per capita grant against water and health. That then allows the implementation at the state level to be far more effective and I think accountable. The third is on the MSME. I think there's a need to understand a little bit better what government is doing. I really have welcomed government's approach of leveraging the NBFCs and the small finance banks to go into the lending into the MSMEs, rather than saying we'll use the public sector banks to do that and put the burden on them. The guarantee system is to leverage the part of the banking system that actually has business relationship with MSMEs. And that's, I think, one window that I think government has done a good job. And here, the RBI has done a good job in creating liquidity that is now being transmitted through the NBFCs. At the same time, government has asked us to look at 5 or 6 of the main states where you have MSME to deal with 2 other windows, not only access to finance, but access to firm capacity and access to markets. So we're working with state governments on their special clusters of MSMEs to really give them support so they can go and access the funding. The system is there. It's in the implementation that I think we have to take it through. My last point is there is no shortcut to creating an urban public health system. And I think there needs to be a dramatic shift into supporting the capacity of 10 to 12 urban centers to actually do what Kerala did at the urban centers across the country. That is going to be a very important key to opening up the economy. Without that intervention, you're going to have the engine of growth, which is the urban sector, falter, and that India cannot afford.
Thank you, Junaid. And yes, you're right, I am not that connected, but I did mean the unconditional, not project-based, but the programmatic funding that is probably more the need of the day in the relationship with the states. And I'm glad that you are progressing along those lines as well.
We have reopened the state DPLs.
Right.
Kerala has been the big state DPL story. Whereas when you were, we used to do electricity DPLs, now we're doing general programmatic DPLs to be able to give cash in the hands of states.
And you and I have talked a lot about that and the impact that has had all over the world. So with that, let me close this session. Let me thank all the panelists and all of you for being with us for this extended duration. 3 hours is a long, 3.5 hours is a long time to ask of anybody. I don't want to go into too many end of the IPF comments. I want to actually just open it up to Karthik and Barry. And at the end, I want to thank the entire team that put all this together. But let me turn to Karthik.
Thank you, Shekhar. And, let me just first start, I'll keep this brief, but, just wanted to thank profusely all the participants who, the IPF is made by the participants, by the convening of the people we have in this room. And it's been, it's been just deeply gratifying to see the engagement. When Shekhar and I, in late March, early April, were discussing whether the conference would even happen, I think we decided that the IPF, and Barry strongly supported this, is just a really important part of the Indian policy calendar and has a fantastic tradition of the very top academics and policymakers engaging on the issues of the day. So thanks. We're really glad this worked out. I think the one thing I just wanted to say, in terms of making an opportunity out of adversity, I think the biggest silver lining of all the remote conferences has been, the ability to open these up, and the fact that these used to be high-level, closed group meetings. It was obviously it was valuable. We got a lot out of the coffee and lunch conversations that happened between the sessions, but there was still a sense in which the richness of that discussion in the room, to the extent that this is a public good. I have always, and in fact, I've agonized about development economics conferences taking place in the US without access to, people in developing countries who are being studied. And, as a board member of BREAD, I pushed very hard this year, and I think BREAD was about to cancel the conference as well. And I pushed, and we successfully managed to make this a globally open development economics conference that had participants from around the world. And, we've now done the same thing with the NBER next week. So the announcement here for everybody, as well as for the students and the attendees who are not panelists, I think, it was kind of poignant in that opening felicitation of Esther and Abhijit, to think about all our own times 20 years ago as young grad students having access, and as Esther as a young assistant professor, and how just being in the conversation, that exposure, and how much that's helped us and shaped our research. And as we think about building the next generation, I think the thing I'm most excited about, frankly, is an unintended positive effect of this pandemic, is just being able to open up these conversations and democratize the discourse, even if the attendees are not necessarily joining, to have the chance to hear such a high quality panel day after day at a time when the TV discourse is, the less said about it, the better. And you can have occasionally a thoughtful conversation by thoughtful anchors with, one or two leading thinkers. But to put together a forum like this, of this kind of quality, with the engagement of members of the Finance Commission, multiple former governors and deputy governors of the Reserve Bank of India, multiple former chief economic advisors to the government, and a deeply committed research panel that's shown an engagement with India policy issues over the past 15 years. To me, the big kind of unintended positive of this has been the opening up and the democratizing of the discourse. So, I think even in a world when we would be able to go back to doing in-person meetings, I think the positive change that I hope will stay is figuring out ways to either live cast, webcast, and kind of make the proceeds available to a much broader set of participants. And I think going forward, now that we have the ability to do this, I would, in fact, one of the things I'm going to push, I pushed this in my editorial role in the past 4 years, getting papers to increasingly think about what are the things that states can do. And I think, Junaid, I've been preaching this for 10 years, and I think going forward for the next year, maybe we can even do this in a way that allows more state finance secretaries and state chief secretaries to dial in and be part of these conversations, so that at least the ideas are being translated down, and then individual states are able to reach out and saying, here's an interesting idea, what can we do about it? I think the other thing that Shekhar and I hope to do with this incredibly rich IPF this year, I think the topics were couldn't have been more appropriate. Everything from the first panel and Prachi's, the first session on talking about the impacts on the economy, to Ajay's paper on public health, to the papers today on state level convergence and yesterday on inflation targeting, is to then kind of see if we can have smaller group follow-up discussions with concerned government officials. I think senior people have come and have been chairs, which is wonderful. It's a way for them to be engaged. But I think we need to do a lot more than just kind of seed the ideas, but kind of roll up our sleeves and do the follow-up work needed to take the ideas in these papers and these discussions to make sure they're actually reflected in policy. And to the extent that each of us in our own roles has some way to kind of accelerate the translation of these ideas into policy, my hope is that that's what IPF will become more and more over the years. And I think, this has been an incredible gathering. We've received a lot of private compliments for what's been put together here. And thanks again to the authors of the papers for putting together excellent papers at short notice at a time when the traditional model was upended, and really again to the participants, because it's your engagement that makes the whole event happen. And for the younger folks, who are both in the attendees and in the panelists, all of next week, the MBR Summer Institute programs on development economics, education, public finance, and I think even labor economics are now being webcast. So it's just like a phenomenal opportunity to just at least be aware of, both the technical cutting edge as well as the topics that are being worked on, and to, just be able to then take those ideas and bring them to India and increase even more. In fact, the IPF's origin was about creating a forum to encourage more domestic research on topics relevant to India that were not being kind of, finding favor with global journals. I think the good news in the past 20 years, thanks in large part to people like Esther taking the role at, who we felicitated in the first session, the editorial roles at the AJ Applied, now kind of running the AER. In fact, there's one interesting anecdote I must say just about, the publication business and the policy business and how IPF tries to straddle the two. There've been very important papers of late that Esther has kind of taken a call and saying, if this was done in the US, it would be published in the AER. So the fact that it's in a different country shouldn't in any way detract from the importance of the underlying question. So in that sense, the academic publishing world is also waking up to the fact that 80% of the world lives in developing countries. So 6 lives in India. And I teach a class in the Indian economy that has 80% of the students are non-Indian. And it's because India is both intrinsically important to the world and kind of a provider of global public goods and services. So I think the IPF is a marquee event. And to me, the landmark of this particular event was the ability to open it up. And I hope, that this allows a deep enriching of both the participation and the quality and the follow-up that happens from the IPF. Thank you. And thanks, of course, to the NCAER team that made this happen, but Shekhar will do that.
I'll do that in a second. Barry?
I have nothing to add. I thought this was a great success, but I have no further comments. Thanks.
Thank you, Barry. I have already put up the names. I noticed that some names were missing. I apologize to Rajneesh that his name wasn't here, and I quickly added it, as you saw. This is all possible with the digital technology we now have, and I fully second what Karthik said. We had no idea that there would be all these wonderful externalities that we normally hadn't thought about, and that have been created by forcing us to use this medium. I do want to thank the people who have put all this together. I have their names up here. They've worked very, very hard to do this. They've supported me and Karthik and Barry, and those of you who've written papers and have been discussants, they've been incredible in terms of the work that they have done. We've learned a lot. We expect to do a lot more of this. There's also the thought that we might start an IPF laboratory that would allow us to showcase work in progress during the course of this year, as many new ideas are being brought forth to deal with the current coronavirus pandemic that's going around the world. With that, let me end the IPF 2020. I really do want to thank every one of you for being with us. A number of attendees have put up questions. This is a very good question from Veena Kulkarni at Arkansas State University. We will take these questions and transfer them to the discussants and come back to you with responses. Thank you all for being with us. Thank you all for staying so late in India, and we look forward to remaining connected with you. And as the IPF model grows based on some of the things that Karthik said, we will need your help, your guidance, and your assistance in continuing this very important and seminal event. Everybody, good night, stay safe, and we'll try to stay connected with all of you. Thank you. Good night.
Bye.